How was your drive? Look, a new background. I actually like the solid. I thought about painting this wall black when I first moved in here, but I just didn't feel like.
This is the background you like, the bare blue?
Yeah, kind of.
I think I'm going to spend some money and get a new light because I hate my setup. And I don't know what I'm going to do with this backdrop yet. I may not put the pictures back up like I used to, but I'm going to do something tricky.
Just do a green screen and then you can do everything you want.
I was thinking about doing a green screen and then just doing like, I can do continuously changing advertisements, or I can do all sorts of just obnoxious stuff.
Just find a way to make Google AdWords appear in your background.
No, well, you know me, I wouldn't advertise so much as just say things that I think are, on my mind, like, quotes of the day or something like that. I might just do a green screen.
Here's I'm going to ask you a question. You got 30 seconds to answer it, since we're not talking the future, but we are, because you and I have been going back and forth on this. What is your take on the idea of cell phones and or chips? The idea of being able to contact trace individuals so that if I was tested positive for COVID, the government would be able to see who I ran into over the last 10 days.
I think it's what I say on the internet, straight out of Orwell. I think not enough people have read 1984. I also think it's inevitable. So if you've also read 1984, the premise is don't bother fighting. So, yeah. They're going to track us. They're already starting to do things like take your temperature before you enter public places. Not anywhere I've been, but I know it's coming. And so, they're going to get your biometrics, and they are going to misuse it. And anybody who's listening to this, if you're not upset every time you go through the TSA, then you don't understand you don't understand the damage of totalitarianism. And so people will welcome it because it'll seem useful. It'll seem reasonable.
Yeah, right now I got demonized yesterday for saying that I thought that was like, I don't want that app.
Well, what do you care? Look, if you...
No, I'm not saying it offended me. I'm saying like it was funny to me that it was like, how dare you not be okay with this if it might save a life? And I was like,
oh, you got demonized? Didn't you say that on a thread that I started?
Yeah. I was jumping into your honor, and then you just left me hanging. It was great.
Let me tell you something.
I'm joking. I'm joking.
Let me tell you something while we're on this. I'm going to tell everybody my style. Ready? This is the key to social media. And your instinct, right? Your petty natural instinct is to get the last word on things when you argue. On the internet, you should always let the other person get the last word. If you go back and forth 1, 2, by the third time, I can tell. I'm like, no, I'm done. I'm done first. You can have the last word, because then you're sitting around waiting for me to respond while I'm moving on with my life.
Yeah, which is exactly why if you go down far enough after I made a few points, I just ended it with like, hey, obviously we're not going to agree on this. Have a great day, or I hope you have the best, or something. And then there were a few comments after that I never, whatever. Anyway, it's all funny.
I'm here to instigate, not.
Yeah, it's entertaining. But that being said, today's guest, because we normally talk about this, is Scott Lewis with Spartan Investments, who I met when he came and spoke to our mastermind group.
You're listening to the Military Millionaire Podcast, a show about real estate investing for the working class. Stay tuned as we explore ways to help you improve your finances, build wealth through real estate, and become a person that is worth knowing.
What's up, guys? Today I wanted to stop and sponsor my own podcast by myself, which is a little cheesy, to tell you about the course that I'm launching called From Zero to One, Real Estate Investing for Beginners. Now, this is not a course to help you get rich fast. This is not a course to promise you to make $1 bajillion, but this is the course that will help you get from 0 rental properties to 1 rental property. It is designed to get you through your first purchase. Everything you need to know to get you through that step, with support from myself, obviously via email and whatever, so that we can talk and I can help answer some of those questions for you. And it is extremely affordable right now because I'm launching it for only $97, which, given the amount of content in there and the testimonials I got from the people who tested it beforehand, I am super on the low end for that price, but I'm going to probably have to bump it up in a little while. But for now, to test the waters and see exactly how many people I'm able to help with this. I want it to be extremely affordable because I want to help service members and veterans get their feet in the water. So if you are interested in learning about rental properties and you just want to learn how to get your first one, and then there are some bonus episodes in there to help you advance past that. But if you really just want to know everything you need to know to buy your first property without screwing yourself over, this is the course for you. Go ahead and check it out. The link will be down below in the show notes. And back to your episode.
Hey, what's up, everybody? It's Dave and Alex from the Military Millionaire Podcast. Look at that. I didn't even introduce you as a co-host. You're getting more official every time. And we've got Scott Lewis today, who is the CEO of Spartan Investments. He's an Army veteran and been in for 13 years in the reserves currently, and did some active duty time in there as well. And Scott and I met when he came and spoke to the mastermind group that I host with Stu, and I was impressed and reached out to him right after the speaking and said, hey, I'd love to get you on the podcast. And now that none of us have day jobs anymore, and we're all stuck inside, it just seems like the world is coming together for scheduling podcasts. So Scott, thanks for joining us today.
Thanks, gentlemen. Appreciate you inviting me on the show, and looking forward to chatting.
Absolutely. Why don't you give the audience a little bit of your background and tell a bit of your story?
Yeah, so I was kind of late to the military. I was 27 when I went in, and I went in the Army through officer candidate school and OCS route in the Army. It's called 09 Sierra. If you've got a college degree, you can go to basic and then go to OCS after that. And then your story is the same as everybody else's. But military was always something I'd wanted to do, but I got a pretty good gig out of college, and I'm a big integrity guy, and there was some integrity stuff that was going on at the top levels of the company that I didn't really like. So I started to look for another job and at business school and kind of figure out what I wanted to do with my life. I was 26 when I started looking, and I was like, you know what? Screw it. Let's sell everything I own, abandon a condo in downtown Chicago, and join the military. That sounds like a fantastic idea. I've always wanted to take an 80% pay cut. And luckily I didn't take a haircut. That was not a big change for me at the time. So that was good. But I kind of came to the military late. I went in with the specific kind of thought of to serve my country and get some leadership experience and get some leadership education and training, and then come back out. I really didn't even have any design to do the reserves or National Guards. I've done both, but I've kind of found that that's a little bit better for me than active duty. Active duty was a little bit too much all the time for me, but I really have enjoyed my time in the Army Reserves and Army National Guard. And I've gotten to learn, additional Army stuff as I've moved up in rank that's been very, very, very relevant for what I'm doing out here in the civilian world. And when I got off of active duty, I went and I worked for the government for a while. That was a complete waste of my life. So then I didn't enjoy that. I didn't fit in really well. So then that's what kind of prompted me to start Spartan, because I was basically unemployable by everybody else.
I love this story. Look, I feel very similar because I've been a misfit in the what you're supposed to do type of world, W-2 jobs, military, corporate America. I've always been a misfit, which sounds similar to yours. You're just like, I just don't fit in. It's not a good fit. I'm going to go off and do my own thing. So what was the initial Spartan? How did you start it?
Yeah, so I was working for the government at the time, and misfit is a great way to put it. I didn't like the government didn't like me. But I had, with some of us that have had federal jobs before, there can often be time in your day, depending on where you're working, as to pursue other options. And I had that time. So I'd been in real estate. I was a framer in high school and college. That's how I got money. So I kind of had the real estate from the built environment kind of perspective, not the investment perspective prior. And I really enjoyed just kind of being out there, and I enjoyed real estate and building homes. So I was like, let me try this flipping thing. And there was a house. I was living in DC at the time in a neighborhood that was kind of gentrifying. And I did a big renovation on my home in DC. They're called pop-ups, when you tear the roof off and you add another story on top of it to get that additional square footage. So my wife and I did a pop-up on our house, and then the house in between mine and my would-be business partner a couple years later was this just really ramshackle row house that was really bad news bears. And my wife was like, hey, you need to do something about that. what the hell do you want me to do? Like, so at the time I didn't know we were doing it, but we started a direct mail campaign because this was probably 2010. So Bigger Pockets really wasn't out there, and wholesaling and flipping, it was there, but it certainly wasn't mainstream like it is now. Like you weren't seeing it on HGTV and stuff.
Well, 2010, everybody was still reeling about real estate too. So you couldn't go to your friends and be like, I'm going to do real estate and get a bunch of people excited because they were still really bearish about the economy and real estate in general. So, okay.
That was a really good time to buy. We did really well on both those properties, my own and usually if your friends think you're crazy, you might be onto something. And all my friends thought we were just absolutely bananas for buying where we were buying. When we moved into that neighborhood, there was housing projects. There still was housing projects, but the demographics were definitely low income, African American, your quintessential DC kind of gentrifying neighborhood demographics. And when we left 6 years later, it was like 25-year-old like Caucasian women running around with strollers. It moved incredibly fast in that neighborhood, incredibly fast. But we figured out how to get that house. And it was funny. I scraped together, and this is, for folks that have a TSP, the old adage is never take a loan against your TSP. Well, don't take a loan against your TSP to buy a boat, but take a loan against your TSP to do your first real estate deal, so long as you have a decent probability of it going well. And for this one, I didn't have any money at the time. So took $50,000 out of my TSP, asked my father-in-law for $50,000 at dinner one night. And that's all I could scrape together was $100,000. I had spoken with the woman a couple of times, and she had always said, I had sent her a couple of letters, had spoken to her mom. And then finally I called and her mom answered. I'm like, hey, let Davida know I can pay $100,000 for the house. It's all the money I can get together. And, I'm willing to buy it. And they called me back, and this is where integrity really goes. They're like, are you sure you want to pay $50,000 for that house or $100,000 for the house? They're like, that seems like a lot. I'm like, well, I think that's what it's worth, and that's what I have, and that's my offer. And they're like, okay, we'll take it. The day I signed the contract, our real estate agent offered us $200,000 for the paper. It was valued at like $375, and that was just like we didn't know that when we bought it. I was just $100,000 is what I could scrape together between me and my father-in-law to do that deal. And one of my other buddies threw some money in as well.
Shh, wait, Alex, I have something to say first.
I just want to make sure we all remember this 2010. So anybody who hears this and tries to go out and do it now is going to have a much more difficult time.
Yeah. This one was 2012. Not much better. I bought my house in 2010 and my partner bought his in 2009, but this was 2012. But still, it was still pretty low.
So Alex missed the key part of this whole story, and I'm going to just point it out as if Alex missed it because he always gets all the good questions. But to me, the main point of this entire thing is you had no intention of buying that freaking house. This whole thing started with your wife saying, that house sucks, fix it. And I think that's a huge piece of what entrepreneurs do, more so than necessarily go and look for opportunities, which is great, but solving problems. And so you got into this investment because you were like, that thing's an eyesore. Like that thing sucks. We got to do something about that, was kind of the mentality, more than like, ooh, I read this book and I heard I can make $1 million through this. But it turned into like exactly what the laws of the universe say. If you solve a problem, like, anyway, so
but to be clear, the problem wasn't the eyesore. The problem was the wife.
Yeah, true. But it's funny. There was another house between my partner and I on that street on L Street Southeast in DC. We bought and rehabbed 4 row homes on that street. 2 of them that we lived in, the one that was right in between us, and then there was another one down the street that was also condemned. That just through a chance meeting, we actually found the attorney that was working with the lawyer, and this is I can segue into a really kind of a key point here for folks just getting into it. It's a little bit like, again, I'm looking backwards on this, but that particular property, it was a row home, and there was a lot of row homes on the street that were single family. These in particular started out as 2-unit duplexes, a top and a bottom unit. But the zoning allowed for multiple units there. It was called R5 Bravo at the time. They've since done some rezoning and stuff down there. But it was literally, there was an alley in the back of the street, and there was literally, that was the line for the zoning code. So L Street, K Street, right? They're right next to each other. K Street, you couldn't do 4 condos. L Street, you could. So, for those folks that are getting started, like, one of the key things I can say, especially on the residential side of the house, the commercial side, and not so much, but the residential side, if you know the zoning and you understand zoning and you understand how to leverage zoning where other folks don't, you're going to be on different battlefields. So it was between us and one other buyer for that particular property. That buyer was from out of state. They didn't know the zoning code. So they were negotiating as if it was a single family home. We were negotiating as if it was a 4-unit condo. The economics are a little bit different between those two. We had set our maximum price that we could pay for that, given all the financials, at $750,000. When the attorney called, he's like, "Hey man, I've got another offer in. It's for $415. If you guys can do $450, it's yours." I literally about soiled my pants in the chair. I mean, we had $300,000 because we were playing a different game. This guy was going to just renovate it into a single family home in which he could sell it for about $700,000. We were renovating it into 2 condos, which at the end of the day, we sold for $2.3 million. So just like for those 4 condos, right? So the difference there was we knew just that underlying zoning code, and that's how we won on that particular project.
That's the best 20 grand anybody spent.
Yep.
Yeah.
That increase. Yeah. Good for you.
Wow. That's huge. And you're absolutely correct. Just understanding how to utilize the laws that are already in place.
Now, you were boots on the ground in DC, right?
We were. So we were kicking rocks in those neighborhoods. Just like any of us that, you go overseas, you start kicking rocks on the neighborhoods over and over and over again. You really learn them. When we first started with Ryan and I was really kind of just home flipping. That's what we were doing. We would only invest in 4 zip codes inside of DC because we lived it. We knew it. We were kicking rocks on it every day. We knew the streets. We knew the zoning code. We knew exactly what we could offer because, especially if you're in the single family, especially now, there's so much competition for this stuff out there, right? If you're doing a direct mailing campaign, it's no different for us in storage right now. We now mainly focus on self-storage, and we do direct mailing campaigns, no different than the residential guys do. With the residential, it's really a first mover's advantage. When that homeowner calls you and they're like, "Well, what can you pay for my house?" Man, they got 10 other letters that are right behind them. So if you've got to hesitate and you can't pull the trigger right away, you're going to miss that opportunity because the guy behind you can. So that's, I guess another thing is when you should have some sort of tracking mechanism. And it doesn't have to be some snazzy like CRM system. It can be we used Excel sheets when we first started. And that was even before Podio really kind of got out there in the house flipping space. And we could look up a particular property on that spreadsheet that we had sent a letter for. And it was max offer was already listed in that spreadsheet because we'd already done the analysis. So we took a very, very targeted approach. Some guys are sending out 100,000 letters a month. We were sending out 10, but it was 10 properties that no matter what we would buy. If they called us, we were ready. We were over there in minutes, and we knew we had an offer right in front of them, and we knew we could buy
it. Yeah, that's a big thing in this business. Beginners have a little bit of an uphill climb because, I tell people you're separated by those who know you can close and those who don't, and those who don't close. And so if you can just show up and say, "I'm confident that I can close," and then you, God forbid, you develop a track record for it, you get a big advantage just by saying, "I can show up, I can write the check and move forward with it." So that's good to hear you say that.
And it's the same way in commercial. It's a vanity metric, but right now Spartan is 100% contract to close on every commercial deal we've done, anywhere from, $1 million up to 10 million. And, it like I said, it's a vanity metric that I don't really care about. Neither does my partner. Our acquisitions guys really do. But it's one of those things that you really shouldn't be writing a contract on something that you can't buy. So long as everything comes through on the due diligence side. On our world, there's a couple different things. There's feasibility and due diligence. And I guess we'll just kind of naturally wander into the differentiator between the two. for every property that you're looking at, whether it's a single family rental that you're going to buy and rent out, or it's some commercial deal that you're looking at, or whatever, or a house flip, whatever you're doing, you should determine if whatever your business plan is for that particular property is feasible. That's the feasibility side of the house. The due diligence side of the house is like doing your inspections, doing your walkthrough. If it's a commercial facility or a multifamily, like you're checking leases and estoppel stuff, that's the due diligence side. But by the time you get to due diligence, so long as everything is close to what the seller says, you should be ready to buy that. You shouldn't write a contract. At least this is our opinion. So a lot of folks are doing this, but you really shouldn't write a contract if you don't even know what you want is feasible. You can at least get a week or two from the seller to lock it up in an LOI, a letter of intent, or letter of interest, whatever, how it's written in the articles that you're reading about, to get a couple of weeks where it's like, okay, we'll do this handshake agreement and you can determine whether it's feasible or not. They're usually very, very short timelines. We usually try to keep it to 10 business days, 2 weeks, to determine if it's feasible. And then we move to contract. Otherwise, like, don't move to contract. Like, that gets people all spun up. It gets them really excited. They start spending the money in their head. And then if it fails because your business plan doesn't work, that to us is just bad news bears. We don't like to do that. So for us, if we're going to contract, as long as as long as it's what it is, as long as the financials line up, as long as it's not a hot mess from a physical inspection point or an environmental inspection point, we're going to buy the thing.
Yeah. I like that. I think that's valid because I agree with you that a lot of people will, I see, I guess, both sides of the coin. Like, I completely understand the idea of, writing the offer if it goes under contract, like, there's all the due diligence there for the safety net, but that's what it's there for, is a safety net. But as long as what you originally thought is accurate, absolutely. I think it's going to hurt you more almost if you don't go through with it and you earn a reputation for breaking contracts in town. That could be real dangerous.
Especially if you're in the commercial world and you're going through brokers, it'll crush you. If you're the guy that like gets everybody spun up, because brokers, like, when that contract comes in, like that's their bread and butter, right? So for the broker side of the house, you better be a team that can close. And for us, for anybody that's listening to this, especially anybody that's a green or blue suitor or tan suitor, like, you've been trained, especially like you guys, like the Marines, they don't do much right. But one thing you guys do have is adapt, improvise, and overcome. And man, I stole that like fair square. Like, you guys have really squared away uniforms and a really good mindset. Your frontal attack is
the nicest insult I've ever heard.
Yeah, I know. the frontal assault, on every piece of terrain, I don't know that I agree with that, but I tell you what, you guys look sharp and your attitudes are fantastic. The adapt, improvise, and overcome is what make Marines, at least from an Army guy's perspective. And every force should adopt that, because that's really what it's about. So anybody that's listening to this, you should be able to adapt, improvise, and overcome challenges inside the due diligence process by being really creative. And sometimes it will fail. Sometimes you'll get a seller that's just like, yeah, man, not interested. Like, that, take it or leave it. That's probably not a seller that you want to deal with, because there's probably some skeletons in the closet that are going to kind of come out and punch you in the head later on.
It's funny you say that, because it is super, super jaded me in a way, that mentality. And this is something I subconsciously judge people and I have to catch myself. But like, if I'm talking to someone and they ask, like, if it's a super, super, super simple question that they could answer themselves with, Google, and they're like calling me to bug me about it, like, subconsciously, I'm always judging, like, can you not figure things out on your own? Like, I'm the guy who will very quickly respond like, yeah, hang on, let me Google it for you. Like, here's your answer, So I think that's a huge piece to success. Literally the entire way that I built everything and anything that I do is by like, I don't know how to do that. Let me go watch a YouTube video on that. Let me go figure that out. Anyway, so super digress. How did you go from, yeah, I'll buy the ugly house next door, to I'm going to raise, tens of millions of dollars and buy commercial properties?
So we realized that we hated the residential space. It just wasn't really for us. There's a lot of good stuff in it. A lot of people are making lots of money in it. It just wasn't really for us. It was not our skill set. and we wanted to get into cash flowing properties. And quite frankly, I hate people. So I didn't want to have to deal with multifamily.
Speaking about you, David.
Yeah. So, I mean, honestly, that was really what was driving us. And, I kind of have a belief that if I provide you something and we contractually agree that if I provide you something, you're going to pay for that. I don't want the government to step in and stop me from collecting what is rightfully mine because of our agreement. So that, and I'm referencing really as we're seeing right now with the coronavirus, governments are stepping in and stopping landlords from, collecting rent or evicting. And now, of course, there should be some protections, and some landlords would do the wrong thing here, but most would do the right thing. Yeah. What the government isn't doing is they're not stopping in. They're not stepping in and stopping banks from taking those multifamily properties from the owners so they're only protecting the residents, not the owners, when the owners could be in a hurt locker as well. Yeah. And some owners are green suitors that own a 4-plex or an 8-plex or a 16-plex. They're not Blackstone.
I have a tenant in my 10 unit right now who has not paid rent since January, and we were 3 or 4 days away from the eviction process finalizing when the moratorium went up. And now, dude, it's just because of the coronavirus, even though he wasn't paying before that. And I know that's like a super anomaly, but it's just funny because it's like, yeah, but he's not affected by coronavirus. He's right. Social Security and still getting paid and choosing not to pay me. Like, get rid of, so, but that's my only mistake or error on all this, but not error, but it's my only missed payment. But
that was one of the things that really kind of drove us to storage is, how much the government gives a shit about your old aunt, like Ethel's like flower print rocking chair that you've got stored in there. Nothing. So, in addition to just being really easy to operate and really easy to maintain, like an angry tenant can't punch holes in a concrete storage unit wall. Like, I mean, if you want to take a sledgehammer to it, I mean, more power to you. You're going to be really huffing and puffing when and then there's nothing behind it for you to get, right?
And it's going to be on camera.
Yeah, and it would be on camera. So it's one of those that was really pushed us to storage. But to answer your question, we made the decision to go to commercial. And to raise millions and millions of dollars. We did do some raises for the residential side of the house. So we kind of had started to cut our teeth, and we went to a syndication class. And I recommend anybody that's going to be taking money from somebody else, they should find a syndication class, just one of those weekend things. Ryan and I went to the Real Estate Radio Guys Secrets of Successful Syndication in Dallas. We enjoyed that. It was like $1,700, and this was in 2016 or something like that. Really good. Gave us the knowledge that we needed to know that we didn't know shit and we needed to get an attorney. So that's basically what it is. Before you go to that class, you're like, oh, I think I can do this. And then you go to that class, you're like, nope, need an attorney, right? Just make sure you get a good attorney. And I can recommend one to have on here that's a former lieutenant colonel. He does all of our SEC offerings for us. He'd be a great guest for you to have on here, so we can.
I would love that. Let's talk afterwards.
Yeah, we'll circle back. But
let's keep talking so Alex can keep pretending he has a question to ask. I see him; he's trying so hard over there.
But really make sure that like that's the first thing to as far as raising money. But that's really commercial. It's there's Russell Gray on the Real Estate Radio Guys had a comment or a quote in one of his shows that. If you have $100,000 loan, it's your problem. If you have a $10 million loan, it's the bank's problem.
As a banker, I can confirm that.
Yeah. So,
But to be fair, also there's a nuance there that, not to go into a hole about that, but there's a nuance there about where the liability lies. So if you have a $100,000 loan and it's a Fannie Mae mortgage, then it's back. It's kind of your problem. But if it's a $10 million loan and it's on the commercial local bank's balance sheet, then your partners. Yep. Then they really need you to pay.
Yep. So the workouts are a lot easier on that side of the house if something gets in versus the bank just coming in foreclosing. They don't want that thing. Most banks don't want to operate commercial assets, so they'll work it out with you.
You think having a tenant in a crappy apartment trash your house? Wait till a syndicator trashes the entire building. No, I'm just kidding.
Yeah.
Here you go, bank.
Today's show is brought to you by Audible. Audible is offering our listeners a free audiobook with a 30-day trial membership. just go to audibletrial.com/militarymillionaire. Now, why Audible? Audible content includes an unmatched selection of audiobooks, original audio shows, news, comedy, and more from the leading audiobook publishers, broadcasters, and entertainers. I listen to Audible every single day on my commute to and from work. Now, to download your free audiobook today, go to audibletrial.com/militarymillionaire.
Scott, I have 3 questions for you regarding storage versus multifamily.
Yep.
One, part of the reason why I started with rentals is I didn't want employees. You said you hated people. I don't know if you said hated, but you don't like them. But you have to have employees for self-storage. The second one I wanted to ask is self-storage, as far as I know, and I could be totally generalizing here, but it does good in up and down markets.
Mm-hmm.
And then the third question I had was, and I don't know if this is systemic nationally, but when I was in Las Vegas, I noticed something that I had never noticed before over the last few years, which is big box franchise self-storage companies are popping up more and more. And do you notice that? Is it big enough to be a competitor, or is that just some kind of fluke?
So I'll start with the last question and work backwards. So there's 5 REITs out there, real estate investment trusts, that are publicly traded companies for storage. 2 of them that are really well known are public. Those are the ones with the orange doors you see all over. They were the first ones that started in the late 70s in Texas. You got Extra Space out of Utah. That's the green doors. Those are your 2 behemoths. And then you got CubeSmart and StoreQuest are the next 2. And then the National Storage Affiliates, NSA, are this kind of amalgamation of regional owners that kind of partnered up to release the stock. Those are your 5. And then you got some regionals that are around. So kind of more to your point, storage has kind of seen a kind of a heyday over the last, I'll call it 5 years, maybe 2015 to now, because of your second question on how well it did through 08, 09. Storage kind of goes, up and down, but not very much, because, in good times, people are buying too much shit and they need a place to put it. In bad times, people lose that shit and they need some place to put it. So it's really, it's called a recession resistant asset class. Like everything takes a hit. So far we've done okay, but the shoe is probably going to drop for us too. Like maybe not as bad as retail or hotels or multifamily, because there's no protections out there for storage, but we're probably going to see some softening on the economic occupancy side of the house. But I mean, storage is pretty versatile. Most folks think storage, they think of like people with their old junk, and there's a lot of that. Don't get me wrong, but about 20% of our portfolio is businesses leveraging storage space versus really expensive retail or office space. We have a small one in Conifer, Colorado, and there's a retail strip center that's right across the street. If I had a decent arm, which I don't, I could probably hit it with a rock from my parking lot. Probably 90% of all the businesses in there have storage in ours, because when you look at it, that retail, I mean, it's in Conifer. It's probably a secondary little town about 30 minutes west of Denver. But I bet you those retail, maybe $22, $26 triple net annually. Our storage, if you were to compare apples to apples, is probably like 13. So for instance, there's a pet store there. Well, I mean, they store the vast majority of their inventory in 4 10 by 15 units. That's 600 square feet of storage that they're getting at probably 50% the cost of their retail. And when they run out of stuff, they just send an employee across the street, and that employee comes over there, grabs what they need, and takes it back and then stocks the shelf. It's the difference of like 10 minutes, but hundreds and hundreds, if not thousands of dollars a month in rent for those guys. As far as your employee questions, yeah, we do have to have employees. That facility itself actually doesn't have any employees. It's an unmanned facility. It's done all online and with a code to get in and out. But we do. And when you look at it, there's not very many employees. Those multifamily guys, like, you have employees too. Like, they're just called property management companies, right? And if you're managing your own, like, you start to get to 50, 60, 70 units, you've got a maintenance guy and you've got a couple of property managers that are there on site. It's the exact same with us. My thing with not liking people is I don't want to have to deal with 50, 60, 80 tenants when I'm dealing with their homesteads, right?
Yeah.
if you don't pay in storage, 60 days, I auction your shit and I clear out your unit. And it's really that simple. You never make any money. That storage ward shows, that's never happened. There's never a midget on some guy's shoulder wearing nods like in the middle of the night, right? That's not what's happening out there. In fact, all of our stuff's done online. But at the end of the day, my recapture is somewhere between 30 to 60 days. Hell, even in Texas, it allows you to shoot your tenants if they don't pay. You can't get your unit back in 60 days. So that's really why we looked at storage.
It might be
it sounds all reasonable.
Yeah, I love the idea of storage. I've been playing with it, wanting to buy. There's 2 or 3 parks. I don't know if park is the right word, but facility. There you go. In the near vicinity to where I live in Missouri, that I've been in contact with via mail and owners for a while. Just like, hey, let me know. So hopefully I'll be first in mind when they do. Because I walked in when I had a storage unit, and before I bought my first rental property, I remember thinking like the guy had a house so it was all the storage facility units and then a house. And so this older couple, retired couple, he paid them super minimum wage because the house was theirs, and they just had to have one of them at the desk during hours, and not even at the desk, in the living room or wherever, and you ring the door and the little thing would open and, hi, can we help you? Do. And then it'd go down and they were in the house. And I was like, this is brilliant. Like, anyway, so super cool.
We enjoy, we don't let's see. Yeah, we don't have any facilities where we have live on site managers, and we're not a huge fan of that because it makes it dicey if they don't work out. But there's a lot of older, like the mom and pop storages, just like what you're talking about, that have, an apartment over the office or anything else like that. And, generally as far as the load for employees goes, it is pretty minimal. I would just say for listeners, just be careful on buying. Storage is an active business. It's not a set it and forget it type thing, like a single family rental. There's a lot more to it. You've got tenants that are moving in and out. You could call that's the drawback. It's a double-edged sword, right? We can use dynamic pricing like the airlines. Like if you go online and book a unit, it's a different price than if you show up with a wagon full of stuff that you need a unit right then and there, right? So we can do that. And we constantly are changing our prices depending on the amount of occupancy in a particular unit size. If we have 100 5x5s and 98 of them are occupied, those last 2 are going to be really expensive. And we change our pricing per unit size. So it's not like, and it's pretty dynamic. We might have 6 or 7 different unit sizes. In some facilities, you kind of got to build them with the whole kind of schedule of unit sizes. But some unit sizes aren't going to do as well as others. Like in our more rural, the 5x5s, they kind of suck. So those will be cheaper per square foot than say the 10x20s or 10x30s, which in the rural areas, people like those bigger units because they're storing bigger stuff. So it really kind of gives us, it's a double-edged sword there that people can just pack up and leave whenever they want. It's really easy. But at the same time, then you can change the rates very, very quickly.
That's good to know.
So Scott, you started in 2012 flipping, and now you have this really impressive large portfolio of self-storage. And, I want to ask on behalf of maybe new people who are looking to get their first single or their second single family, and they hear your story and, well, I just want to express that, yeah, it sounds fast because we talked about it over 20 minutes, but 8 years. And I just want to, not to take away anything from your success, but 8 years of a monstrous economic run, especially in real estate. And so do you have any advice that you could say, or can we look back and say, it's possible for the next guy to kind of get started in something. Yeah, you can start with a single family, you can start with a duplex, you can start with a flip and then still be able to grow. How do I say it? It takes a lot longer than how long it takes us to tell the story. So any hardships, can we talk about how it was, how do I say it? Harder than it's sounding right now. I just want to put some reality into this.
This is the worst question Alex has ever
asked. I know, I'm sorry.
I'm picking up what you're putting down. So, there's that old adage that if you have 1 hour to chop down a tree, you better be sharpening your axe for 5 hours. So yeah, it sounds like, it sounds like we've had this like meteoric run, but really kind of going into it. Number one, I was probably 34 when we got started. I had a good balance sheet. I had a decent amount of liquidity. I had a lot of equity in my house. Ryan was probably 30. I think he's 4 years younger than me. So he was probably 30. I think he turned 30 right when we got the first property, right? So we weren't 22 or something like that. Now there's plenty of younger guys that are going out there and getting it done. But we had good balance sheets. We were financially squared away. We had good W-2 jobs. So for that first deal, we've never used hard money at all. That first deal, the bank gave us a loan for our first deal on that. And that was $165,000 renovation budget on an 800 square foot house. So, we tore it completely down to the studs. But we were able to do that because I had invested in my TSP, so I was able to get $50,000 out of it. And remember, that's you can only take up to $50,000. So I had more in there than that. So I had the juice, and now luckily I had a father-in-law and a buddy that contributed to the fight there as well. But I had some financial wherewithal. And both of us that signed on the loan for the bank, we had good balance sheets so that the bank would lend us money on our first deal where we didn't have to go do 4 and 14. Our first loan was 1.525 for that deal, right? So instead of giving thousands away to a hard money lender, we were able to do it through a traditional bank. So I say that as it's not, I actually started this, in my mid-20s by being financially squared away and not overspending myself, not buying cars and doing all that other shit. Don't get me wrong. There was plenty of stupid nights at the bar in Chicago when I was in my mid-20s. Don't get me wrong. We've all been there. But overall, I was pretty squared away financially by the time we started to do this. So it enabled us to do that first deal. And that first deal, we made hundreds of thousands of dollars on it. Well, then the next, after that, the bank was like, okay, what do you need? And then we just did the next 3 deals. And even that condo conversion, that was a $1 million loan that Ryan and I secured ourselves. So again, we started out from a pretty decent footing on that as far as getting it started, and then kind of growing. We had good resumes. When you start raising money from folks, we went real short on the bio, but I've got a bunch of education, master's degrees, certificates, all that shit from decent universities. I've got good work experience. All of us have the military experience. That will matter. But we have good resumes. So all of that stuff and that whole ecosystem of really kind of squaring yourself away first before you get started, that's really what kind of helped us move, and people looking at it as being like, okay, these are the type of guys we'll give money to because they've done well in other parts of their lives.
So curious for you, and I'm going to just ask this as a super beginner because I know you've got all kinds of information on this, but on the raising money side, which you do very well, if you were looking to get started in raising money, because I think right now with the way the market is, I'm under contract on a property right now that the bank is asking me for testicle hair follicles to see if I'm qualified. Right. And my finances are wonderful for this. It's like, hey, we've got all this wonderful lending criteria, but we took the normal white picket fence and made it a Trump border wall to get into the actual loan. So it's just ridiculous barrier to entry. And not even financial stuff. It's weird. But so people are starting to look at, seller financing and private lending and all this stuff. So what would you say if someone was just looking like, man, I should look into doing some private money lending, other people's money, raising capital? What would be some beginner, where should they start? I guess would be my question for you.
I think they start in the same place. Make sure. So I am an FA 30, which is an information operations officer. So in the Army, when you get to field grade 04, you can start to kind of specialize in something called a functional area. So I am an FA 30, and within that realm, we have a term called information fratricide. So what you don't want to do is put out mixed messaging, right? So when I say that is everything that you put out should tell the exact same story. There shouldn't be, if you are going to use statistics to make yourself look awesome, like we do, make sure that the statistics on your website versus your one-pager aren't different. Because I'll tell you that if I'm an investor and I pick up a one-pager and I go to your website and it says you've done 10 deals on your one-pager and your website says 6, I'm going to start to think whoa, man, this guy doesn't care enough to make sure that he's putting out the same message. make sure your LinkedIn profile isn't a hot mess. So often,
guilty.
and like, say again.
Guilty.
Yeah. So like, don't take your own picture. Like, none of us look good when we do it ourselves. It just doesn't. So yeah, don't get a professional picture up there, right? You want to put your best foot forward because, as human beings, like, we can see all the data in the world, but man, if somebody just doesn't get a good feeling from you, they're not going to write you a check. And it doesn't matter if it's equity or debt. Banks look at your stuff too. I see our lenders looking at my LinkedIn all the time. So really just make sure, take a month and get all your stuff squared away and make sure anything that's out there facing against the world that has your name on it is uniform across the board. And if there's a problem, it's not a bad thing, man. I mean, maybe you, I don't know, did something stupid in your youth or something like that. Like, if you can find it, you should find it and be aware of it. And don't let some investor find it. Make sure it's there. And if you made a mistake early on, it's not the kiss of death. Just address it, own it, and drive on. Don't let people find it without letting them know.
Yeah, so I think it's interesting. I worked in bank underwriting for quite a while, and I've raised some money, and so kind of I'm on both sides of that in a way, and it's interesting. I think kind of what you're saying, or if I could summarize it or say it in a different way, is people are looking to invest in you more than anything, and so in fact, one of the 5 C's of credit, the first one is character, right? Like the bank, yeah, they're going to go through the financials, but they really want to know that you can pull this off, and that you're going to be good to deal with, and that you are going to be a good investment. And so they're going to Google you, and they're going to go through this. This is part of the underwriting, and your private investors are going to be the same way. Who's David? What's he about? Blah 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 blah. And so yeah, I really like that you say that. Make sure you look good. Make sure you have your stuff together. And some of it, it's kind of like, if you care, it will show, kind of thing.
So one of the presentation I'm giving up at the event that was supposed to be in St. Louis, whose name I forgot, it's with Stu and all those other guys, and Bill Allen that's hosting. I'm giving actually a talk on doing due diligence on the sponsor for a deal, because I argue that the deal, it matters 20%, 80% is the sponsor, because a good sponsor can turn around kind of a bad deal, and a bad sponsor can screw up a good deal. And I'll give you an example. We've got some RV parks in the Permian Basin in Texas, oil company. Needless to say, today is not a good day in our world for the RV parks out there in the oil country.
For those listening, this is April 20th, which is when oil prices tanked to 99% for the last year.
It's at negative $30 a barrel. At least it was when we started.
And yet my oil stock still hasn't dropped below where I sold it last week.
We've got to run. It's now negative $26, down 243% since this morning. So we're doing better than we were when we started.
So when I was a recruiter, someone told me, and it was what stuck with me the entire time I was a recruiter, was if they like you, they'll join. Forget all the other recruiting stuff. If they like you as a person, they trust you, and they believe in you, then they'll join. And I think
we have investors that sign the paperwork within minutes of getting it. There's zero chance, which actually concerns us a little bit. There's zero chance that they looked at any of the information. Why? Because they're like, listen, guys, we know the types of deals that you're putting out. We know your character. We know your integrity. We know your values. So we're just going to sprinkle $50,000 on every deal that comes out. So just send us the paperwork, and they just sign it and send it right back.
See, yeah. So I literally wrote down, if they like you, they'll join /invest.
Yeah,
so I just took the same.
It's exactly what it is. And it's what, if anybody's on the call that's looking to be a passive investor in deals, and they don't want to do their own deals, but maybe they're in retirement or whatever, and they've got money to put with another, put with a sponsor on whatever they want to do it, man, so many folks get enamored with the financials, and they forget that all that's phooey, just like ghost math, right? Like we can make a spreadsheet dance across the screen. That doesn't mean that it's going to be good, right? So at the end of the day, it matters on the sponsor, because the operating environment, like right now, bad sponsors are going to lose their deals because they haven't set it up correctly, or they don't know what to do, or they don't have the team or the planning wherewithal to get through a problem like this. Yeah, those RV parks that we have are in the suck right now, but one of them was bought with no debt. Zero. There's no overhead. Who gives a shit? Like, I mean, it sucks. We're not going to make returns, and that's bad, but investors aren't going to lose their money, at least not today. I mean, if oil stays like this for the next 10 years, we could have a problem. But, you know, I mean, right now that park, I mean, we can take it down to almost nothing where there's no operating costs to it. The other one's at 50% debt. We can have 23% occupancy at an 80% reduction in the rents that we had when we were running at full, and we're still fine. It'll suck. It'll be miserable, but we won't lose the asset. That's about don't lose the asset.
I'm about to go.
First rule is preservation of capital.
I'm about to go take myself a trip up to Vegas this weekend and ask the gas station to pay me so that I can use their gas.
Yeah, exactly.
Like, hey, don't you owe me $1.50 a gallon for this?
Yeah. I mean, it's like, this is nuts. This is absolutely crazy. We used the military decision-making process inside of our company, the Army version of it. And my wife worked for SOCOM for a while as a DA civilian. So we've taught the rest of the company, MDMP as it's called in the Army side of the house. And we use it to build courses of action for each one of our deals. And man, I'll tell you what, this one didn't make it. Even the most dangerous, so there's most probable and most dangerous course of action for the properties. And we went pretty bad with these oil properties when we looked at the most dangerous course of action. What didn't come out with was a global pandemic in which people couldn't give oil away. That one didn't come out.
So that just goes to justify the old adage that just because the worst risk behind you is something you can survive doesn't mean that you know necessarily what the worst risk possible is.
100%.
All right. So I got a few questions I always ask. The first is if a E1, E2, youngster was to walk up to you asking for life advice or real estate advice, what would you tell them was like your, I don't know, key to success, the fairy dust?
Yeah. So there's kind of a thought out there on the ready, fire, aim. I would tell them that that's stupid. None of us would do that, right? That's not what you do. But you also shouldn't be sitting there trying to focus on the target so long that your eyes get tired and your breathing gets labored and then you miss your target. So, really what I say on that is spend a little time educating yourself. Go to Bigger Pockets, figure out what podcasts you like, and then take podcasts and books, and then take 90 days and educate yourself as much as you can in those 90 days and really get after it. That's what we did when we decided to pivot to storage. We shut the company down and everybody read everything we could. We listened to podcasts. We watched YouTube videos. We did everything we could for 90 days. You'd be amazed at how much you can learn in 90 days if you really focus on it. And then at the end of the 90 days, give yourself another goal to do your first deal within 30 to 60 days after that. That's what we did. And we had our first raw land development for storage 26 days after that ended.
Wow. Yeah. Commit to education. And then I like that because it is a delicate balance between analysis paralysis and, hey, look, you're never going to be ready. You got to do it sometime.
Yep.
So yeah, I like that. 90 days, hardcore, turn everything off, hardcore education. There's an old saying that I like. If you read 3 books, you know more about the topic than 99% of the people.
Literally, when we bought a car wash, there were 3 books available. That was it.
Yeah.
That was 3 books, total of 226 pages between the 3 books. It didn't take very long.
And 2/3 of them were saying, hey, here's 5 pages. Sign up for our email list.
That's right. 2/3 of them had pictures in it. So
perfect for you, Scott, right?
Some guy out there.
That's the whole adage. Like, none of us would go to the range without going through basic rifle marksmanship first, right? Because then you would go out there and you just waste all your ammo. You would never hit it. But you don't want to go through advanced sniper school before you get out on the range the first time either.
Yeah. Yeah. And it's timed for a reason.
Yeah. Yep.
Yeah, I like that actionable window. That's good. All right, what resources, book, course, website, whatever, would you recommend for anyone looking to get started in real estate?
Yeah, so I think I would split it up between books and podcasts. Podcasts, I like the Real Estate Radio Guys is a really good one. Kathy Fettke's real estate news or real estate investing. I can never remember the titles of them. Kevin Bupp has a really good one, Investing for Cash Flow. Kevin's a good friend of mine. His is really good. And then Joe Fairless is kind of the quintessential one. And the Bigger Pockets one, great information there. I would say that would be, for people just starting, the Bigger Pockets forum is probably a good launch pad to get in there and read different forums, because there's a lot of different stuff on there, and listening to the podcast, reading some of those books, and then really just kind of determining what's the best for you. I think before you get started, after the education side of the house, that'll give you kind of the idea of what is right for you. Don't just jump into multifamily because that's what's all the rage right now. If you want to be a multifamily investor, then do it. But don't be afraid to say that, like, that's not really for me. I want to invest in dog boarding companies. Okay, that's fine. There's probably people making out a bunch of money on dog boarding kennels.
They're so hot right now. Actually.
Holy shit. I pay $51 a night for each for 3 dogs. Like, holy shit. I go, like, the first time I went there, they're like, that'll be $750. I'm like, I went for a weekend. Holy crap. That's more than I paid for me.
You say they're so hot right now. You might have meant like last month. I feel like since everyone's sitting at home with their dog, they're probably struggling right now.
In general, but that is not, I don't know if you're making a joke or not, but that's a real business model, and it is really growing.
Yeah, 100%. And that's why, I'm during my master's work, we did a project on doing a dog boarding kennel right at the airport. And there's boarding gate kennels right by DIA, right by the airport in Denver. And I was like, oh my God, that's it. I had that.
I mean, it makes sense.
It's about understanding who you are. What do you value? What are your values? What are your skill sets at? Don't try to manage projects. If you're not disciplined and detail oriented, you will lose a lot of money. But then, don't be out there trying to sell if you don't have that personality, right? So know your strengths and weaknesses, and then apply them to whatever asset class you think would be the best for you. And that'll come through learning.
Absolutely. And my final question is, where can people get a hold of you?
www.spartan-investors.com, or they can just email me at scott@spartan-investors.com.
Scott, I am so mad that we didn't hang out in Denver.
Yeah, so I mean, like the best ever. So Ben Lapidus is my director of acquisitions in finance.
No way.
Yeah, he works for Spartan.
That's how I know the name. As soon as you came on here, I was like, Spartan Invest. I know that name. I hung out with Ben at FinCon last year. We hung out quite a bit.
Is he the guy who gave you your money back after you whined to a bunch of people?
That's not what happened. I'm not getting into it right now. And no, he didn't. Ben's good people.
Oh, man. Scott, thanks for joining us today.
No, thank you guys.
Thank you for listening to another episode about my journey from military to millionaire. If you liked it, be sure to visit FromMilitaryToMillionaire.com/podcast to subscribe to future podcasts. While you're there, we'd love for you to rate the show, give us a review on iTunes. Now get out there and take action.